Hello, accounts people. Time to have a look at the difference between tax issues on sole traders and limited companies. I've got a quick list, and there's a bigger list further we'll come back to at the end. It'll make more sense at the end, some of the other issues. So some of the important considerations apart from the actual tax calculation. So first of all, status. A lot to be said for having on your CV director or company owner. However, this risk, this limited liability issue is underestimated sometimes by startup people, sole trader, especially if you've got lots of dealings with third party and liabilities for individuals, whether it's their health or catering or building. Nobody assumes they're going to have a disaster and end up being bankrupt personally to pay off a debt because somebody's house fell down or somebody got injured or food poisoned or something like that, and it wasn't all covered by insurance policies. It is slightly easier to employ somebody and much better really as a limited company. Again, it's the liability issue. You don't want somebody else causing you to be bankrupt, but you've then got the director's responsibility to file the accounts and behave like a director. Underestimated, nobody starts out straight out of university or college as a consultant or as a tradesperson assuming they're going to build up a business and sell it on to pay for retirement, maybe in their 50s or something. But a limited company will always earn a lot more for the owners than selling off a list of customers, which is all you effectively do as a sole trader. A big difference there. Generally speaking, easier to raise finance, although it may be set off against a director's property. And the growth bit we'll see later with the numbers. It's always easier to grow a limited company than a sole trader. Massively financially more viable. We'll see that at the end. Other expenses will be slightly different, so I've had to use the same numbers for my worked examples, which aren't perfect because we know that expenses will pan out slightly different for a sole trader and a limited company, whether it's a use of own property and mileage and all sorts of things work out differently. Even the bank charges will be different. The accounting costs, you'll have the limited company accounts to file plus a self-assessment return, even as just you that owns a company, whether you're a director or not. Limited company can pay you for working at home £6 a week, so there's a typical example of the differences. And then there's massive difference for private use of a vehicle, the scale charges, whether you're an employee or whether you're a sole trader. Van benefit charge for limited company work, so for a tradesperson, that van benefit charge may make a big difference. So the profit figure or the value of having a van for a tradesperson is better as a limited company than a sole trader. Then there's lots of subsistence rules. Again, it's clearer and more precise with a limited company, which is always better. However, you can't make use of the sole trader's trading allowance if you're the sort of occupation that doesn't have many expenses. Or if you're only a small business. One of the other differences, there's no FYA. This is to do with capital allowances, so business tax students will recognise this, personal tax students won't have come across it. We always ask these questions because you only see part of the picture studying one of the AAT units. If you studied the ACCA combined unit or the future combined unit on AAT, you'd see the picture from both sides, but sole traders don't have first year allowances apart from certain types of vehicle. So your plant and equipment is effectively capitalised over more years, whereas a limited company, most plant and equipment is capitalised in the first year to reduce the tax bill. So those little things can make a difference, and we know the numbers therefore are always very artificial. The only way you could do this, even for a low earner, would be to do it retrospective to work out whether they would have been better off with all the figures in there, redraft them from a sole traders into a limited companies and see what happens. So these are very simplistic examples. They're not perfect. I haven't bothered to round everything down as the HMRC, but they're good enough for general comparisons. So somebody making £20,000 profit after allowable expenses, including the capital allowances, would pay 6% on the top bit of that profit on the self-assessment return process, and 20% on the top part, totalling up £1,931 after rounding down. HMRC does tend to round down to favour taxpayers, so when you actually put the numbers on HMRC, you find it will round down, if not on a spreadsheet or a computer package. So if that person was a limited company, we'll assume they're paying themselves a salary of $12,570, so that adds payroll costs to the accountancy fees. Although obviously third-party specialist companies don't charge a massive amount of money for doing payroll for you. And then the national insurance is all the employers. That's the difference between the 9,100 threshold and the 12,570. I'll prove later that you don't go down to the 9,100 threshold to avoid employers. It doesn't pay off. That's all at 13.8%. Employees is nothing because it's under the threshold. Above that, of course, it would be 8%, and then it drops down to 2%. Corporation tax will be a straightforward 19%. It's under the £50,000 threshold. Now, this calculation assumes that all the money is being paid out to live off. So it's all coming out in terms of dividends. We've taken off a single allowance. Obviously, a married person could split it sometimes and have double that allowance. And you can see it works out as about £317 more tax. However, the allowable expenses would possibly wipe out that difference, but you'd have to work out afterwards. Very, very complicated model to put all the expenses in. You'd have to have a pattern over a couple of years to see whether it's worthwhile. So most people would say it's probably not worthwhile on that kind of level, going to the additional problems of turning into a limited company. Doesn't cost a lot to turn into a limited company. The full company's house rates aren't passed on to people if you go through one of the portals, because they're subsidised by offers of bank accounts and insurance and advertising and websites. So it normally works out £50 sometimes to set up as a limited company. So we'll have a look at the difference. Not much there, probably disappears in the expenses issues, but a decent earner. So a couple of versions here. You can see there's a table off to the right we'll have a look at in a minute. So £50,000, that's a good accountant or professional or junior professional, junior solicitor or something, and that's again, so this could be actually straight out of a partnership set of accounts as well. So as a sole trader, again, self-assessment returns, a little bit at 0% and then 6% on the rest. They're below the threshold where it drops down, and the same for income tax, not quite into higher rate. 12,570 works out 9,731, give or take, with a bit of rounding down. So the limited company, if that person was a limited company, you can see just by looking at the bottom how it pans out. There'll be a little bit of employers, national insurance, so again you've got the payroll costs, annualised if it's a director, paid in instalments if it's not a director, although directors count as employee and pay the same rates. And in the corporation tax, straightforward 19%, because it's 37,430 minus 478, it's still below 50,000. So if all that money was being paid out, I put in two allowances here. It's all at the basic rate, all well within the basic rate tax band. Works out at 2,531 at 8.75%. So again, £300 or so more tax could disappear because that profit figure might drop a little bit for a limited company with legitimate expenses. Just to prove that you don't drop down to the £9,100 for a threshold, you've still got an employee, so you've still got payroll costs. That saves you 13.8% on the difference on the £3,470, but then you're paying 19% on corporation tax because that's an allowable expense. Gives you more dividends, I suppose that looks better, and again you're still at 8.75%, so actually dropping down to the threshold for employers doesn't work out. Now the big difference is about the growth issue. What happens if you don't need that £40,000 or so in cash terms to live off? You can leave some of the money in the business. So on our right hand table here we've got £10,000, give or take a few pence, being left in the business account for future purposes and investment and growth. We've got the same employers, same corporation tax because dividends are paid out after corporation tax. However, the individual's tax bill on dividends is a lot less. So suddenly, if you can leave money into a limited company, the tax position is effectively deferred until later stages of growth. And you can see there's a almost £600 difference in tax for being a limited company if £10,000 in this case was left in the business account and not paid out as dividends. We've got a bigger difference with a bigger earner, and instantly see the figures. Sole traders, so this is £90,000 after profits. Now this is a little bit too simplistic because you'd have pension contributions and vehicles and all sorts of stuff to cloud the issue. Obviously limited companies can have an occupational pension, and that expands the 37,700 gain. Obviously give as you earn or some other charity donations as well expand that 37,700 band and take people both from income tax and higher rate payments on dividends. That 37,700 band will get bigger. And of course occupational contributions come out of salary, so you can actually pay yourself a little bit more salary. So anyway, sole traders, 3 bands. We're getting into the 2% band now, so it's a much lower rate once you've gone above 50 to 70 effectively. And then income tax, pretty much the same numbers. Again, they're into the higher rate tax band here, so £90,000 profits, 26,500 give or take in terms of tax disappearing on the self-assessment payment schedule and regime. Limited company, we can see a massive difference. So corporation tax is now on the marginal relief rate, so this works out at 21% give or take. Lots more. This again is all the money coming out in terms of dividends, 2 people's allowances, and then that's a mixture of basic rate and higher rate. That looks horrendous, but if you're earning profits of 90,000 and you don't need 40-something thousand pound to live off, let's keep some of the money in the business, and in fact we're going to keep £20,000 in the business. Same corporation tax, that doesn't change. That was the profit after tax, before dividends, so £20,000 now being kept in the business. Of course that's saving money at the higher rate, at the 33.75% rate, and therefore the tax bill suddenly becomes lower. So we start to see the picture. Limited company, if you're leaving money in a business for growth because you can, or you're just having a really good year or projecting a really good year, that's good tax. What's the key factors? Okay, obviously bear in mind corporation tax and national insurance is the business account, tax on dividends the owners. Just below the high rate earnings, actually no, this one isn't, this was just above. Actually I'll put that one in from the previous page, and it's down to the dividends. The higher rate earner, so a lower rate pays the difference between 20% income tax and 8.75 is 11.25. However, higher rate instead of 40% is paying 33.75% on dividends. That's only 6.25%. And of course they're higher rates, so of course they're also paying higher rates of corporation tax. So the savings, the dividends over income, direct income, isn't so much, but yes, we know there's other factors involved. Let's just have a look at a couple of other factors. We've explained that growth issue and leaving money in the business, the effects we've now seen. Obviously, rules for directors and non-directors are different. You could be a small company, a small limited company, but you're not the director, even if you own 100% of it. And this affects all the payment dates. National insurance is annualised for directors, so you can't have good earnings and bad earnings to try and manipulate the national insurance rates as a director. Directors are counted as employees. What we haven't seen is the effect of pension types on these calculations. In occupational pensions quite often work out better than what's on offer for a sole trader or a director. We've also seen the difference between married or a civil partner, because we could share the dividends. You saw 2 times the dividend allowance. However, if you do employ a civil partner or husband or wife, employment needs to be genuine to pay them some wages, in which case you can then potentially make some use of the employment allowances. That's possibly why I come across so many people who started their bookkeeping and accounting career doing their husband or wife's accounts. And therefore we can tax plan. Whoever's on the lowest band gets more of the dividends. You'd much rather pay 8.75% than 33.75%. This isn't avoidance or evasion. This is tax planning within marriage or civil partnership, and therefore perfectly ethical and legal. Bear in mind, obviously, if you're single, you can't share dividends with anybody unless they actually own part of the business. A sole trader, of course, can't share the dividends. There's no dividends, the tax bill, but they can employ somebody. Payment dates for corporation tax depend on year end, and that can spread out the tax payments. You're still having to do a self-assessment return and paying the January and July dates. However, corporation tax depends on when you've set the company up, and therefore your year end. I mean, you can change the year end if needed, and therefore the payment dates depend on the company's year end. And that will actually spread out tax payments, and that could be where there's not much difference, a good cash flow help. So what is the difference? Well, yeah, it's the unspent money in the sole trader can be left in the company, and that's why there's no tax on the dividends for growth. Deferring effectively tax. If that money is used to make growth later, there's more tax going to be paid in the long run, but in the short term, that's always good, and that's why we saw the biggest difference, especially in the bigger earner. There's also some other rules about losses, so maybe first year of trading comes as a loss, or there is a bad year or two as a business builds up, whether it's a sole trader or somebody as a limited company, and they can be carried forwards and backwards differently, different rules. And there is a lot more considerations. I'll just only put down the main ones, but I think the main one here is in bold.